On the right-hand side, you see a slow move towards institutionalization, mostly predicated on the reaction to GFC. And we see the green piece, which is still quite substantial and remains a key factor in the European market. And that's one of the key differences that we need to look at between the two investable markets. And here you see, and this is not to scale, so what you can't see is that Europe, in terms of fundraising, number of funds, and the amount of capital raised, is approximately half that of the US. The US, as I said before, is a much more established, mature market. It's been around for 15, even longer, 20 years. I think most of the investable opportunities 20 years ago, if not all, were in the US. Now, I think investors, irrespective of currency, have a decision to make between the two, and each has its merits. As I said, we're going to explore some of those now. What we've also seen, as discussed this morning, was the rapid expansion of credit markets, both liquid and illiquid. And it's one of the key themes that we need to think about when investing, whether or not the supply of opportunities is equivalent to the demand for yield in each market. Now, some of you may be familiar with this chart, and what I'd like to do first of all is to ask my panelists to explain the risk and return opportunities in each market across these sub-asset classes, because this is the first point of entry for most investors. So perhaps, Orla, first of all, can you maybe explain to us the opportunity in terms of risk and return in Europe amongst these asset classes?
Yeah, sure. Hello, everyone. Thanks for bearing with us this late in the afternoon. I think probably taking a step back, John, I would start with saying that, you know, as a firm, our first foray into something of a direct lending product and overall strategy, we first started with the US, and the reasons are, for those that you mentioned, it's a more established market, it's broader, deeper, and then I believe at the time the return differential was not significant, but as we've seen base rates change, that's where the differential has come, particularly in the last 12 months. I think still on a risk-adjusted basis, if you're looking at the pricing just from a margin perspective, and leaving out the base rate, it's still quite compelling. At the same time, I would say that given the rapid growth of direct lending, corporate direct lending in Europe, we've seen a huge number of funds moving into the space, and that's from both the more established private equity shops and also just standalone private debt shops springing up. That has bifurcated over the last, I would say, 3 years probably, such that you've got really the bigger players and then the smaller players sort of not managing to achieve scale. But all of that has meant that there has been quite a bit of pricing compression, particularly in Europe versus the US. At the same time, you'd have a little bit of erosion on structure, so covenants going down. I think to some extent it's something what you would have seen in the US, Olga, but I think that overall and on the whole, on a risk-adjusted basis, Europe remains a pretty attractive place to invest.
So one factor I see there straight ahead of us is this characterization of the unitranche market versus first lien direct lending in the US. Can you just explain that and what that means for risk? Are these equivalent asset classes?
Yes and no. Am I allowed to give that kind of a response? The way we tend to look at unitranche is, just being at this firm specifically, is that we look to what level it goes down through the capital structure and to what leverage level in particular. What we are incredibly sensitive about is the tranching of a unitranche, so how it's going to be split, particularly post-signing. Oftentimes what you'll see is a first out, second out component. I think the US tends to be, a first lien, second lien up front. And I think, for us, what we would like to maintain is an understanding of how that tranche is going to be split. So what ultimately happens, and it's actually a feature we're seeing more and more, particularly in Germany, is that there is more and more of a first out component. We want to make sure that whenever we're investing on behalf of our clients, that we're not actually inadvertently investing in something that looks more like second lien. How do we kind of circumvent that? We would probably put limitations around the turn of leverage to which you can cut the unitranche first out, second out.
But my last dollar of risk in a unitranche product in Europe, is that, broadly speaking, at the same level as my last dollar of risk in a first lien product in the US?
Broadly speaking, I would say yes.
Fair enough. Now, I see there also you have 60 basis points of long-term loss rate assumption for Europe. How do I take that as credible? I know that the European market has only really existed since the GFC. We haven't seen any of these managers that you talk about adequately tested for restructuring, etc. So how can I believe that that's a credible number?
Well, I think, first of all, to have a track record, to have a manager with a track record through the cycle in Europe, it is rare. But it's not, there are a couple of managers who've been working through this space. A lot of the time they would have had their predominant focus being on mezzanine rather than first lien. I think, how do you get around that? I think you need to make sure that the teams that you are investing in, because fundamentally you're investing in the teams looking to source, originate, and execute these transactions, that they do have a significant strength in restructuring, because it will happen at some point. The key issue around restructurings when they happen, it's not the end of the earth. I think if you look at the recovery rates versus defaults, I think it can be quite compelling and give some level of comfort. The issue becomes that it's so distracting and it's just so time consuming focusing on restructurings rather than sourcing, originating, executing, and ultimately deploying further into the direct lending space. So I think that's something to bear in mind. Make sure that your team has got solid restructuring performance. I think the 60 bips is, it's based on information that we have so far. I think that if you look at the US, for example, slightly lower at 50 bips. The US on the track record basis goes through prior multiple cycles, and there are peaks there. So I think that's probably why you're seeing a slightly lower loss rate.
Just to challenge you there, I mean, if I look at a European manager with a 60 basis point loss rate since 2011, for instance, that's been the most benign credit environment in history. Yes. And if they're losing money during that period, why would I believe that they can save my money through a downturn? Maybe
they can't, and then that's when it comes down to manager selection.
Yeah.
You've got to be incredibly thoughtful about how you look at it. Actually, we don't tend to look at the loss rates. We look at the default rates also, and we would constitute any default as being any change to the underlying credit agreements, not just an actual event of default, because as we know, most of the time it never really gets to the stage of a formal event of default. There'll be some kind of a waiver or an amendment executed on that, and that's something we're quite mindful of.
Thank you. Olga, turning to you, I'm looking at the gross return assumptions there, which are above both Europe and above 8%, indicatively in that shaded area in the middle. We also see a lower loss rate. Now, my question to you is, surely this market has been, broad enough, deep enough, over-competitive. Where do you see the alpha or the excess return opportunity, or where do you see the investment opportunity at this stage of the credit cycle? Surely every possible competitive advantage has been blended away.
That's a great question, John. And one of the comments on the defaults and losses, I fully agree with our first panel that we had this morning, that recoveries in the next market downturn are going to be one of the points that will truly differentiate managers between themselves. So recoveries is something that's in the covenant light, predominant issuance currently is going to be one of the key issues. So this 50 basis points is probably going to be potentially much larger across different managers, and maybe even double, because currently we're assuming almost 80% recoveries. But going back to your question on alpha, well, there's different ways to achieve it, and one of them is a structural alpha, where, for example, in our case, we focus on creating a private debt platform which not only takes into consideration manager selection and their underwriting quality, but also we focus on fee negotiation. And because of the scale, we manage